Hello and welcome. This is the Insurance ProBlog Podcast. This is episode 415. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Yes. And we're actually talking about life insurance today, so bonus.
Life insurance and tariffs.
Tariff accessories.
It's going to be a tariff. No, I'm not going to do it.
Everyone just stopped listening. That begs the question, what do tariffs have to do with life insurance?
Well, the question that we came to answer is life insurance, cash value life insurance, like whole life and index universal life insurance, are those a good hedge against the bad things that happen in the economy when you go bonkers on slapping a bunch of tariffs on everything?
Yes. There's your answer.
Okay. Well, then thanks for joining. We got this one done early today.
We got to do better at not giving you the answer until the end.
Yeah, we should have waited.
But we'll tell you all the reasons why it's a good hedge. So there you go.
Make sure you listen to the entire episode because there's 5 things we're going to share at the end of this video.
Yeah.
No, we're not. I'm just kind of practicing my YouTube skills.
There's actually only 3 according to the notes, but okay. I mean, if you got a bonus too, then I'm all ears.
Well, if you always use one more or 2 more categories than are really there, it keeps them listening till the end.
That's right.
Because they're keeping count. But then, no. This recent economic circumstances have been a bit strange, and it's caused some anxiety and volatility. And this is not our efforts to jump into the foray of a politics podcast. I have no desire to do that. But we do deal in facts and numbers, and right now markets are not good.
The facts and numbers are not great at the moment.
Yeah.
We are feeling the pain.
This is one of those moments where we look at the various assets that exist to people and say, hey, there's one that's doing just fine.
Yep. Had virtually no effect at all.
And not only is it doing just fine, but we predict with all of the implications of what's going on, we'll continue to do just fine.
Yeah. I think so.
So that's the important piece here, because volatility is somewhat dangerous to everyone, regardless of the stage they're at in life.
Yeah.
Granted, if you are younger, kind of in the accumulation phase of life, volatility is less problematic in some respects. Really, though, it's only beneficial if you continuously invest.
I was about to say, it's beneficial if you're young and you're sitting on a ton of cash that you can put to work. Then it becomes a boon for those people.
Yep.
But we're guessing there's not that many of those people.
I mean, judging from the typical person that reaches out to us, I'm going to hazard the guess right now that the 28-year-olds that are sitting out there on $1 million ready to deploy it, they're either just not talking to us or there's not that many of them.
Yeah. Both.
Yes.
I think it's 2 things can be true at the same time.
Correct. That is correct. But really, focusing in on life insurance, and especially talking about it in the context of income and other related strengths that it has as an asset in times of volatility. There are really, I think, three kind of categories that stand out.
Right. I think you could label life insurance the anti-volatility asset. This is one of those.
That's an interesting statement. Elaborate.
This is one of those cases where boring is good. This is when I didn't even tell you, I got a message from a client yesterday saying, really happy I own what I do on days like today. So I'm paraphrasing, but that was the sentiment. And that's not the first time we've heard that.
Nope.
Heard that a lot in 2022.
Yep.
It is boring when everything else is going to the moon. That is life insurance. Seems very boring and very passé and very not really sure why I'm doing this because everything else is going up. And, this is, as we talked about, this is the 4 to 5% asset over time.
Yep.
And I'm not really sure what I'm accomplishing by having this. And then we go through periods like we're experiencing now and you go, oh, now I remember.
Mm-hmm.
So I think that fits in well to the three things you're going to talk about.
It does. And as an aside, this is a pro blog, pro bonus tip.
Ooh.
That very
Nobody
nature,
even knows what a blog is anymore, by the way. That's
right,
how long we've been around.
This is why the 28-year-olds aren't reaching out to us. What the hell are they talking about? But
insurance don't like that. Blogs don't know what that is. No thanks.
Oh, this episode is brought to you by Werther's. So
cardigans and Werther's.
The fact that people do get very anxious in moments where the market is taking off and they could be sitting on something like life insurance, which is not taking off because it never does.
Right.
There is a certain amount of thinking and the strategy that goes on with insurance companies to figure out how to stop people from leaving at that time.
Mm-hmm. Mm-hmm.
It's one of the reasons surrender charges exist.
Yeah.
So you
don't actually have this money, but we're going to show you what you could have in an alternate universe.
Mm-hmm.
And
so be quiet, sit back down,
instill a little FOMO in you so that if you leave, this is all you get to take.
Yeah. But it's a serious dilemma when it comes to pricing insurance products, managing the assets of insurance products. They can't deal with inflows and outflows like that and create the guarantees that are associated with life insurance. So there's various systems that need to be put in place to stop people from leaving.
Makes it really hard for them to stay competitive in a competitive market.
Yep.
I don't mean like the stock market. I just mean competitive in a marketplace for insurance products. It makes it difficult to manage.
Correct. And it turns out a negative rate of return is a really good way to get people to go, we're going to wait this out.
Yeah. It'll be positive eventually.
Mm-hmm. So I said there's three things that life insurance really shines brightly on when it comes to volatility, and we'll run through them. We'll start with what I think is kind of the most interesting one, which is retirement income.
Right.
And I promise you, there are a lot of people who are entering retirement right now who are learning an extremely valuable lesson about the pain volatility can create when you are trying to take market-linked assets and generate income with them if you're selling them.
Yeah.
When volatility is high.
Yep.
This is not a good time to do it.
No.
And for those who are, it is going to permanently revise your retirement prospects.
I mean, think about that. The people that were, planning on taking a certain amount of income in March from their portfolio. Mm-hmm. And right now they're looking at it going, or April coming up in a couple weeks.
Yep. I don't know if I want to do that.
Right.
I need to do that, but I don't know if I want to.
Right.
Now, there are multiple strategies one can employ to do it and do it successfully with far less impact.
Sure.
These are things that you and I know quite a bit about. We've talked about for a number of years. And if you want to know more about that, you should reach out to us. But life insurance is definitely a way to ignore all of this noise.
Right.
Because the one thing I can guarantee you about all the whole life policy holders, all the index universal life insurance policy holders, all of this volatility in the market doesn't have an impact, a meaningful impact on the ability of those two products to just generate the income they were going to generate.
Right. To my knowledge, we've not gotten any panicked phone calls or emails.
Nope. Now, we will talk about index universal life insurance more specifically in just a little bit because people are going to ask, well, if it's tied to the market, this is not good. Yes, temporarily, but it still, long-term, doesn't really affect it much at all.
Yep.
Next up, emergencies. So, we've got that R word floating around. And generally, when recessions take place, there are things like job losses.
Right.
Yep. In fact, right now, there's a number of people who are formerly employed by the federal government who are no longer. And
or soon moments, will be.
Right. And in those moments, sometimes you take distributions from retirement accounts like 401ks, not because you just want to.
Right.
Because that is the thing that's going to keep you living in your house.
Despite all the experts on the internet telling you that's a terrible idea. Well,
right.
It turns out if you need money, you need money. So it doesn't really matter how bad of an idea it is. But you're going to take it too. This is when you're going to take a huge tax hit for doing that. It has no teeth because turns out if I don't have any income,
right. Marginal tax rate's going to be low anyway.
It's not a tax hit.
Yep. And if making that bad decision and just living with it means I get to not fall behind on the mortgage or the rent, guess what? We're going to make a bad decision.
Yeah. And we personally know plenty of people who have had to make that decision.
Absolutely. And it's a compounding problem because now not only are you selling at a bad time, it just is.
Yep.
It's a bad time for more than one reason. It's a bad time because if you're not 59 and a half, you're going to pay additional taxes on it.
Right.
Now, your marginal income tax may be less because your income is zero, but you're still going to pay that tenant penalty.
Right.
There are some exceptions. There are, but for a lot of people, it's going to happen.
Yep.
And the market's down. So now you're selling at a depressed price per share, plus incurring additional taxes on the distribution. But you have to, because the alternative is something like get kicked out of the apartment you live in, lose the house that you've been paying a mortgage on, lose the car that you have a loan outstanding on, whatever the circumstances are, the obligation that you have to meet, you have to do it. Because if you don't, there's going to be even bigger problems that you face.
Right.
So the fact that you're going to lose, not only by selling at a lower price, but also possibly additional tax burden from it, that is the less bad problem.
Yeah.
And yes, it's bad, or yes, it's less ideal, not great, but it has to happen. So the idea that premature distributions for 401ks happen because people just decide, we're going to do it. No, it's done out of necessity.
Yeah.
So
it's not an immediate problem. It's like, that's a next year problem, and I got a right now problem that I need to solve. So.
Right. And it's too often brought up in the context of, well, you shouldn't do that because it's bad for these reasons. Well, yeah, but there may be some other reasons underlying it that explain why we're doing it.
Yeah.
There are other ways,
Living
though.
in a refrigerator box on the sidewalk with my kids is arguably worse.
Far less exciting. Yes. There are other assets, though, life insurance, that you could go to in these moments and face none of those consequences. Not going to change your tax burden at all, not going to create any sort of additional tax liability, and also really not going to be that affected by the fact that you took the distribution now. It doesn't really care.
Yep.
You're not having to sell at some reduced price because nothing went down because of the market. All of those things work out quite well. The timing of it is irrelevant. Last one on the list, which I think excites a certain number of people, but I will be honest with you, it's not the easiest one to execute. Opportunities. So if you're sitting on cash and asset prices have been hammered down, you have an opportunity to buy in at a low point.
Yes, you do.
Some people, I don't know where I am on this, are suggesting that for the next 30, 60 days, there may be an incredible wealth building opportunity to buy into the market at a low point-ish and reap the rewards from that. I'm not so sure that I'm going to follow that advice, marching in necessarily, but that's what you believe and you're sitting on cash, life insurance could be one place. You can definitely take advantage of what you think the opportunity is.
Yeah. Well, we definitely saw that in the last, not so much during 2022 or COVID, because those were really short-term loss events or asset price depreciation events. But in the financial crisis, people who were sitting on a lot of cash, whether it was life insurance or any other asset, and did things like bought Florida real estate, as an example.
Yeah.
From banks. So foreclosed, they're paying 10 cents on the dollar for that stuff. Those paid off handily. That's always my thing when people talk to me about this opportunities. I'm dwelling here on the opportunities thing for a second, but
That's okay.
and I know this is going to sound vague to some people, and other people are going to totally understand what I'm saying. I always say it's a good thing to do because you are. If you're taking the cash from the cash value of life insurance, if you take it as a loan, then you're not taking away all the earnings capacity of that money. You do have interest accrual, and it's unlike some purveyors of life insurance disinformation. It's not better to borrow your money than to leave it there. Did anyone get that? I don't know, but you can't borrow yourself rich. Or whatever it is that she says.
Spend and grow wealthy.
There you go. But there are
potentially a registered trademark. We don't know, but if it is, there you go.
There are times that, as someone from a flooring store in California is going to send us a dirty email. There are times that there can be a very clear arbitrage situation that you can take advantage of. And I say, just to finish what I was saying about it.
Yeah, yep.
Wait until it's obvious. It's an obvious fat pitch over the middle of the plate.
Mm-hmm.
That's always my, because people will ask us about various things like, look, I can't give you advice on what you should or shouldn't do in terms of what you're going to do with the money. That's not within my purview at all. All I would say thematically is wait until it's an obvious fat pitch.
Yep.
Whatever it is.
Right, because anything outside of that, you're at best just reducing the cost.
Right.
So for those who are kind of listening to this going, what the hell's going on? The concept is the fact that you can take a loan against a whole life policy.
Yeah.
Or really any cash value product. And the loan itself does not cause a loss of the earnings of the cash inside the policy, because a loan is issued kind of against or separate to the whole life policy. Cash value continues to grow, continues to earn dividends to some degree, depends on policy.
I was going to say, depending on the policy, it will likely be reduced by something as opposed to just leaving it there, but it won't cease to earn.
Right. So that means that you are still growing the pot of money despite the fact that you've effectively taken the money out because you're spending it on something else.
Right.
That is a truism of life insurance.
Yep.
It is a very cool feature of life insurance.
Mm-hmm.
And that gives you the option to essentially leverage the asset to purchase a new asset.
Yep.
And hopefully grow both.
Yep.
That's the ideal. Brantley's point in all of this is just make sure that whatever the investment is you're pursuing outside the life insurance is something that you have high confidence in working out. Because if not, we have to start to call into question if it was worth taking the loan against the policy to do this.
Like a bad example would be, well, my brother-in-law's business, it's been he's been operating it for 25 years. He's never made a profit, but I've got a chance to invest. Mm-hmm. Maybe not the fat pitch you were waiting on.
Right. Conversely, too, there's a laundromat in town and the owner just died and the kids don't want it. So it's on sale for like 25% of what it should sell for. Yeah. And
it has a $125,000 a year net cash flow and I can buy it for $50,000.
There you go. That's a little different.
Yeah. That's a lot more obvious.
Mm-hmm.
Doesn't mean you can't lose, but.
Nope. But the odds are more in your favor.
Yeah. Exactly.
Now, in addition to just the lack of volatility that life insurance deals with, we think quite strongly that insurance companies themselves are uniquely positioned to weather the coming potential storm from tariffs and trade wars and things of that nature, because there's not much that insurance companies are exposed to that would be a negative force on their balance sheets or their income statement. This may well put the inflation discussion right back on the table.
Yeah.
Which increases interest rates, which is not something the insurance industry weeps over.
No.
So
the higher interest rates over the last couple of years have positively impacted all of the policies that we have on the books. That's for sure.
Yep. We should be clear. we call it the Insurance Pro blog. It's actually the Life Insurance Pro blog. So this does not apply to home and auto.
But what
That's
about your workers' comp, Brandon? Let's talk about that.
Nope. So price increases to things like building materials and cars. That's not great for the home and auto insurance industry. They don't like that much. They have some mechanisms to deal with it. That upsets consumers, but they're not as insulated. The life insurance industry is really not that at risk.
Well,
so I mean, not only does
the only thing that really affects returns in life insurance are interest rates. Yep. And they're not immediate, by the way. We've talked about that a bunch. It's not like an immediate change. I'm just saying long term, interest rates have a much greater impact on.
Yeah, and the nifty quirk to insurance is the fact that insurance assets, which are largely comprised of bonds, are valued based on their ability to produce income over time.
Yep.
So, unlike certain other financial institutions, which really worry much more intently on the liquidatable value of the bond today,
right?
And that could cause problems for them financially speaking.
Right.
Insurers are much more heavily reviewed value-wise by the value of the bond and its stream of income.
Yep.
So
the net yield is what they care about.
Yep. By virtue of that,
because they don't have, in general, I'm not saying never, but in general, they don't have plans to trade, to sell the bond.
Correct. Yep. So by virtue of all that, if interest rates move in some direction, the change in value of the bond holdings has far less problematic impact on the insurance company.
Right.
Now, they're not immune. There were insurers who took losses in 2008 from things like hedge fund positions, general stock ownership. That did have a negative consequence. Not a destructive one, but it had a negative consequence.
Yeah. It's typically such a small percentage of what they do, of what their investment portfolios hold.
I remember in 2008, AIG was at the epicenter of the entire problem because of credit default swaps and their decision to be the counterparty on that. And American General is an insurance company that AIG owned.
Yep.
And when AIG was in really rough financial shape, there was a lot of discussion inside the life insurance industry about what was going to happen to American General. Like, what's going on with American General? But like, there could be problems for American General is fine.
Yep.
They had nothing to do with credit default swaps. The business itself was entirely unaffected by what was going on around it.
Yep.
And it's
the only negative impact
consequence
was the name.
was its association with AIG.
Right.
Because it was owned by AIG. And nothing problematic came to American General following any of that. So insurance companies, by their nature, are fairly risk-averse investors to begin with by regulation design.
Yeah.
Not necessarily because they're Boy Scouts. And so that puts life insurers in a position to weather problems like things that could be unfolding today.
Yeah.
So product is stable, and we also have a lot of confidence in the companies that issue those products to remain stable. Now, we should address index universal life insurance in this context, because as you may know, or you're going to learn right now, index universal life insurance pays an interest rate that is usually tied to the movement in an indexed, most commonly the S&P 500.
Right.
That would follow, on a very superficial logic standpoint, that if the market is down, that's not good for index universal life insurance.
Right.
Because you wouldn't receive an interest payment if the market is down.
Right.
And that is true. But the one thing that index universal life insurance has going for it is that movement in the index is looked at over some period of time, almost always 1 year.
Right.
So if the market is down at your anniversary date, you now get to reset at that lower point.
Yep.
And whatever the movement in the market is from now for the next 12 months becomes the interest rate payable a year from now. That is extremely different than I own a position that just took a 10% drop and now I got to wait for it to come back up to break even, and then whatever happens from there is gain.
Right.
If it's positive.
Yep.
That periodization of the way earnings take place, watching movement in the market, sets indexed universal life insurance up in a position where it can benefit even when the long-term general trend of the market is down. We've shown this before by looking at the lost decade, the 2000 to 2009 period, and showing people that despite the fact that holding something like an S&P 500 index fund during that period is slightly negative, indexed universal life insurance products are all positive in that time frame.
Right. It's the magic of the annual reset.
Mm-hmm.
Sound like a brochure.
In addition to that, the life insurance industry, despite its reputation for being a little old and boring, does have a bit of a fascination for innovation.
Mm-hmm.
And a lot of indexed universal life insurance products more recently have been introduced with alternative index options. Some of them other stock index options, some of them foreign index options, but also bond style index options and blended index options that seek to kind of tactically change allocation based on volatility in the market.
Right.
So this normally looks something like shifting away from stocks and into bonds. In some cases, more recently, shifting out of stocks and into bonds and or cash to capitalize on what likely takes place in those asset classes when volatility is high, which generally speaking means they go up.
Yep.
Not always, but sometimes. So those products actually benefit incredibly when we see markets decline. I'm not going to say like what's happening as we record this, but markets decline as they have in the past.
Right. Yep.
So that puts indexed universal life insurance in a place where it might actually perform in a way that is somewhat surprisingly good when those features are available.
Mm-hmm.
And if you really, really don't like any of that, you can always just use a fixed account and collect whatever that interest rate is.
Yep. Not been terrible the past few years.
Has not at all. And we would be extremely remiss if we didn't remind everybody, as we do from time to time, but probably not often enough, that annuities are life insurance products too.
Yep.
And annuities come with all the same protections in terms of volatility that whole life and indexed universal life
aside from variable, and we're not talking about any variable products.
We're not talking about variable products. They do it in a different way. They have different consequences and different features.
Yeah.
But when it comes to creating a stable income in a volatile environment, annuities are extremely good at that.
Well, it's
what
they were created to do. Like,
and this is especially true if you are somebody who is just retiring now, going, well, what am I going to do with this money to actually have income that's reliable?
Right. Yep.
So insurance products are absolutely a hedge against circumstances like
what we're seeing right now.
What's going on right now. Yep. And what's going on right now could very well be a dramatic market volatility event.
Yep.
That will cause losses for people and will absolutely disrupt plans.
Mm-hmm.
Whether they be retirement plans or vacation plans.
Right.
There's disruption. The retirement plan disruption will be more impactful.
Mm-hmm.
And this stuff is what we exist to plan for.
Right.
And as we have said a few times in the past, we don't know what the next event is, but we know it'll come.
Mm-hmm.
We didn't know in 2002 what would lead to what's going on right now, but here it is.
Right.
And these sorts of things have a way of coming along every few years. And this is the reason why we advocate for the ownership of the products that we've just spent a half hour talking about. Because they insulate you from these problems.
Yeah.
And they do it really well.
It's just prudent to have part of your money, a portion of your liquidity, not exposed to volatility.
Mm-hmm.
I mean, it's just a very pragmatic position in my opinion.
It's incredibly pragmatic. And if you want to know more about how you might go about doing that, you should reach out to us by visiting theinsuranceproblog.com and clicking on the Contact Us link at the top of the page.
And I almost always, I think, put a link in the podcast description that sends you right to that contact page. So if you're on your phone or whatever, you can click on that link and it'll send you straight over and you can reach out to us.
And talk to us.
Yeah.
And with that, I think that's all we came for today.
All right.
So I'm Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.